Good morning, it's Jeffrey Christian of CPM Group. It's about 11:10 on Tuesday, the 20th of December. This will be CPM Group's last video of the year. I want to talk about what's happened and what we think might characterize 2023. The title here, Annus Horribilis, for this year, certainly fits the bill. And next year we think is going to be the year of transition. Big changes in a lot of areas: national, international, financial, personal, social, political. It's going to be all over the place. Talk a little bit about a year-end review and an outlook for 2023. I have talked about this repeatedly in recent videos, but it probably bears repeating one more time. As I'm speaking, the price of gold has gotten up to about $18.32 today. It had fallen last week, but it has spiked up this week, this morning. CPM Group's most recent trade recommendation said that I had a target of $18.50 at some point in the last 2 weeks of the year, between now and New Year's. The price is about halfway there. With silver, our target, I think, had been $24.70 or so, and the price has gotten up to $24.36, having sold off last week and recovered today. So that's our short-term view. Before I get into the review and outlook, we have set the dates for our yearbooks for 2023. The gold yearbook will be launched on the 28th of March with an online briefing. The silver yearbook will be the 25th of April, and the platinum group metals yearbook will be the 25th of July. And I want to talk about changes we're making to our trade recommendations, both in terms of how we report them and also how we measure the hypothetical returns. Things are going to change. That's what John Lee Hooker sang maybe a decade or so ago. If we look at what happened in 2022, gold prices are at an average record high. There's a lot of kvetching by gold bugs about how low the gold price is and how low the gold price has been in the second, third, and fourth quarters of this year. But the reality is that on an annual average basis, gold prices are at a record high, surpassing last year's record of $17.99. It's not clear if it's going to be 1801 or 1804 or 1805, but it's going to be over $1,800 most likely, unless the next 2 weeks are a continuation of Annus Horribilis. So the prices were very strong in the first quarter, and that made sense. We had started 2022 with a lot of investor and market concern about inflation. That led to market concerns about rising interest rates and what would happen to the broader economy, and that led to concerns about recessions. So we had this package of financial market angst and uncertainty that was pushing precious metals prices up in the first 2 months of the year. That was then added to by the Russian invasion of Ukraine and the spike in oil prices and other things. First quarter saw high precious metals prices, gold, silver, platinum, palladium. The rest of the year saw prices coming down a little bit in the second quarter, much more sharply in the third quarter, pretty much what we had expected. And then they stayed weak into October. They started rising in November and have shown further recoveries so far in December. Actually pretty much in line with what we had expected for the year, although prices of gold and silver fell further than we thought, price of platinum fell further than we thought, and the price of palladium fell pretty much what we thought. Going forward, 2023 is going to be a continuation of 2022. We will continue to see inflation concerns, although headline and core inflation are likely to trend lower. They'll trend lower in a slower way. The gold market will still have all these gold bugs talking about hyperinflation, which just isn't going to occur. But the broader financial markets are looking at disinflationary trends. They're not looking for inflation to fall sharply in 2023, although it could toward the end of the year. But I think the financial market consensus right now is that core inflation might be about 4.5% by the end of the year, and headline inflation might be 5% or so by the end of the year. So slowly seeing a deceleration in inflation. We already are seeing a slowing in the pace of increase in interest rates. That probably will continue into the first quarter of next year. CPM Group's expectation is 25 basis point increases in the Fed funds rate in February and again in March, then a plateauing into later in the year. And that will come in concert with our overall economic expectations, which I'll talk about in a second. But one of the things that you're seeing now is that we've seen interest rates rise and rise sharply over the course of 2022. The increase in interest rates has not thrown the world or the United States into a recession. And the broader financial market is realizing that even though interest rates have gone from 25 basis points to about 4% over the course of 2022, at 4%, the Fed funds rate is pretty much at the low end of the rate of Fed funds rates from the 1970s, 80s, and 90s. So the realization is, yes, interest rates have risen, not so much as to trigger a recession, and that there is scope for a little bit more. But the economy is slowing. At the beginning of the year, there were any number of people who thought that we would be in a recession in 2022. Didn't really happen. We had negative 1.6% real GDP in the United States in the first quarter and negative 0.6% in the second quarter. Technically, that's a recession, but there were a lot of pockets of strength, and the decline in overall real gross domestic product was relatively small. Then we had relatively flat GDP on an annual basis in 2022. CPM Group's expectation is pretty much more the same for 2023. We expect very low real GDP growth in the United States, Europe, and Japan over the course of 2023, weakening as the year goes on. We still think there will be a recession, but the probability is that it won't arrive before the fourth quarter of 2023, or more likely 2024 or 2025. So we see low growth, which will be reflected in that interest rates. That arc of interest rate projections that I just talked about reflects that. Relatively decent first quarter, and then weaker second quarter, third quarter, and then in the fourth quarter, really starting to slouch toward a recession. And that probably will occur, and that would also have, obviously, a major influence on interest rates. Gold prices, we expect them to rise about 1.5% on an annual average basis from this year in 2023. So another record year for annual average gold prices. We see gold prices pretty much moving sideways throughout the year, starting to rise perhaps toward the end of the year and then rising more sharply in 2024 if we see a recession and a financial crisis and other things. And I have to reemphasize something that we've talked about before. Interest rates and monetary policy will not throw the US or the world or the industrialized world into a recession. What will cause the next recession will be a combination of fundamental supply and demand issues within the real economy, supply constraints and stronger demand than supply can meet, and fiscal policy, which remains gruesomely overly stimulating right now. And it has to probably come down at some point by force, if not by reason. It could come down by reason, but no one's ever accused Congress and the administration, any administration, of being reasonable. So we do expect a recession, probably not in 2023, and we don't see it being caused by a rise in interest rates. That'll be a factor, But the major factors that we worry about for a recession are fiscal policy, which has nothing to do with monetary policy per se, and real economic trends in supply and demand for goods and services. There's still a lot of constraints there, and they're probably going to get worse over the course of 2023. So we expect flat to slightly higher gold prices in 2023. We expect a little bit stronger silver market. I think we're looking at about a 6.5% to 7% increase in the annual average silver price. Like gold, we sort of see it trending sideways over the course of the year. We have a range of $20 to $28, which is what silver traded in for most of 2022. There were some spikes below 20. And we do see silver then, moving higher beyond 2023. Platinum prices, we think, will continue to try to build a new base around $1,000, and palladium prices will continue to weaken. Platinum and palladium will suffer from weak auto sales, and if we see a recession in 2024, 2025, or even 2023, when we see the next recession, that will be detrimental for the PGMs, as will the continued shift and growth in electric vehicle markets at the expense of cars that burn either diesel or gasoline, both of which need PGMs to clean up their exhaust. So that's our view for the markets. As you can see here, talked about the world, talked about the metal markets. One last factor. Russia, the government clearly had been planning for a new offensive in Ukraine. The expectations of Western military analysts was that they would wait into the early spring. They saw how the mud worked against them in February and March of this year. So they were apparently looking for an early spring offensive. Now they seem to be shifting to a January offensive, partly because there are indications that the Ukraine government was planning to preempt any spring Russian offensive with an earlier one of its own. So both sides are girding their loins for a continuation of the battle. And that's going to have obvious implications for the global economy, global political cooperation or lack thereof, and precious metals markets. Now, I want to talk a little bit about our trade recommendations. These are the ultra short-term trade recommendations that we make: gold, silver, and we'll probably be adding platinum and palladium in January. It's our expectation. We've always pointed out that these trade recommendations are not the way CPM Group invests or would have our clients invest on an ultra short-term basis. We would modify them much more often. But the way we trade precious metals or invest on a short-term basis doesn't really lend itself to published trade recommendations. So we've compromised that on the trade recommendations that we publish. We're making some changes to the trade recommendations. We're adding stop losses to the trade recommendations in the reports. That'll probably start with the first trade recommendation in early January. We're putting in a $30 gold stop loss and a 50-cent silver loss on both buy and sell recommendations. I'll show you some tables in a second as to why this makes sense. We've been looking at the directional track record versus the target hitting. Now, I have to say, the data I'm going to show you is based on hypothetical portfolios based on the trade recommendations. These are not actual trades and actual results. This is if somebody were following our trade recommendations with the parameters that we outline in footnotes in each trade recommendation. These are what the results would be. If you look at gold, and you say, what were CPM Group's trade recommendations from July 2018 when we started publishing them until our most recent one on the 13th of December? If you looked at it and when did we hit the target or we issued a new trade recommendation, the collective loss would be $258. But if you had traded them more in line with what we do, and this is still not the way CPM Group invests on an ultra short-term basis. If you looked at it, okay, we hit the target, or we issued a new trade recommendation, or we hit a $30 stop loss, the collective cumulative return would be a positive $536. Almost $800 difference between just the rudimentary things that we've been publishing and using a $30 stop loss. Carlos Sanchez loves stop losses at CPM Group. I've never been a big fan of stop losses, but I do like to trade as if I have stop losses. But I don't necessarily like the mechanical aspect of stop losses. I like to be able to say, no, let's do this now rather than do it. But if you use stop losses, you would take a $258 loss and make it into a $536 profit. They're pretty good. The other thing is, okay, silver. Without the stop losses, cumulative, and we only started these in April 2021, cumulative loss of $7.26. But with a 50-cent stop loss, which is what we're planning to use in calculations going forward and in trade recommendations, with a 50-cent stop loss, it would be a positive $3.32 on it, or more than 10% of the current price. And then we looked at it directionally. We said, let's step away from the hypothetical returns and say, how many times did CPM Group get the direction right, regardless of whether or not we hit the target? And with gold, we've made 187 trade recommendations since July of 2018 when we started this. Of those, 65% or 122 of them have been right direction, even if we didn't hit the target. And 65% of them have been wrong. So a third of the time we've been wrong on our direction, 2/3 of the times we've been right. And I just showed you what the results were in the hypothetical model that we use. With silver, we only started in April 2021. We've done 71 trade recommendations. And of those, about 56% of them, we got the direction right, even if it didn't hit our target. And in 31 of them, or 44% of the time, we've got it wrong. Silver is much more volatile and harder to predict and invest in than gold. And anybody who's been in these markets knows that. A couple last things. There was a joke. There was a poster in the economics department at the University of Missouri in Columbia when I was a student there. And the poster said economics is the only social science predicated on the idea that people act rationally. It's very funny, but it's not true. Economics say, if you assume that people act rationally, this is what would happen. But the assumption is that people don't act rationally. I was at a conference in the 90s with the World Bank. It's looking at commodity options for agricultural producers in developing countries. And various academic economists said, Mr. Christian, the Black-Scholes model and other statistics suggest that commodity options should be priced at X. But if you look at actual commodity price options, they're usually at a premium to what the models and the efficient market theory would have you believe. What are we looking at? And I said, the efficient market theory says if a market is efficient, if information is spread evenly among all of the participants in the market, and they have the same level of sophistication, knowledge, and capacity to execute properly, if it's an efficient market, then the option should be priced at X. But commodity markets, not just gold and silver and platinum and palladium, but across commodity markets, are highly asymmetrical. The distribution of information is incredibly large. Some people know a lot about what's going on. Some people know nothing about what's going on. And these are asymmetrical, inefficient markets. They're much less efficient than major currency markets or bond markets or stock markets. And that's what you're looking at. Economics is not predicated on the theory that people act rationally. Economics is predicated on the wish that people would act rationally, with the knowledge that they won't. That sort of, I distill it into, it is better to think than to believe. See you next year. Take care of yourself. Have a good year end. Take a deep breath, because next year is going to be a year of transition. And it's going to be a very interesting year.